All right, welcome to the Explainer. Today we're getting into something that's, well, it's a big deal for any tax audit. We're talking about Clause 21 of Form 3CD. You know, it's one of those things that can seem a little intimidating, maybe even confusing, but getting it right, it's absolutely crucial. So, what's really lurking in a company's profit and loss account? For any tax pro, that's the question, right? And when you're doing an audit, Clause 21 is pretty much your treasure map, or maybe a mine detector. It's the part of the audit that really makes you comb through every single expense, looking for those items that just aren't allowed and could get flagged by the tax authorities. Yeah, you can really think of it as the auditor's magnifying glass. I mean, if the P&L account is the story the company is telling about its year, Clause 21 is the part where you go in and check all the facts. And let's be clear, this is way more than just a box-ticking compliance exercise. It's about finding those potential bombs, those liabilities that are just sitting there hidden in plain sight. Okay, so here's how we're going to break it all down today. We'll start by decoding what Clause 21 is all about. Then we'll dig into capital and personal expenses, payments under Section 40, and then Section 40A. After that, we'll touch on contingent liabilities and wrap it all up with the auditor's final say. Ready? Let's jump in. All right, first up, decoding Tax Audit Clause 21. Let's really get to the bottom of what this thing is designed to do. So, when you boil it all down, Clause 21 has one main job. It's there to highlight expenses that have been put into the profit and loss account, but are, for one reason or another, not actually allowed as a tax deduction under the Income Tax Act. It's basically the bridge between what the company's books say and what the taxman will accept. Okay, let's get into our next section, capital and personal expenses. This is where we hit the first big area of scrutiny under Clause 21A. And honestly, it's one of the trickiest parts. Telling a real business expense from something that's a capital cost or, a personal expense. And wow, look at this list. Subclause 21A really casts a wide net. You've got the stuff you'd expect, right? Capital expenditure, personal expenses, but then it gets really specific. We're talking about things like ad spending with a political party, club membership fees, and even fines or penalties for breaking the law. These are the gray areas where things can get complicated. And this slide really gets to the heart of a classic practical problem for auditors. The whole capital versus revenue debate. Is an expense for the day-to-day running of the business, with its benefit used up pretty quickly, or does it create something with an enduring benefit that's part of the business's core structure? Think about a massive software overhaul. Is that a one-off cost or an asset? It's not always clear-cut, and the auditor has to use some serious judgment based on legal tests to make that call. Now, while some of this is about judgment, other parts are just crystal clear. Take a look at this quote from Section 37(2)(b). The law doesn't mess around here. It says, flat out, no allowance for ads in anything published by a political party. There's no wiggle room, no gray area, it's just a straight up no, period. Okay. Moving on, let's talk about payments that get scrutinized under Section 40. Now, you gotta pay attention here because these rules are powerful. They can actually override other parts of the Act and lead to some huge disallowances. And usually it all comes down to one big misstep, not handling TDS correctly. This table lays it out pretty nicely. The biggest issues you'll find under Section 40, the real red flags, are payments made to people, whether they're residents or non-residents, where the proper tax deducted at source, TDS, just wasn't done. And another big one, reported under 21C, is when you see payments to partners, like salary or interest, that go above the legal limits. So this all leads to a super practical and, let's be honest, a very common problem. What do you do when you, as the auditor, think an expense should be disallowed, but your client completely disagrees? They have their reasons, their justifications. Now what? This is where professional integrity really comes into play. But the good news is a disagreement doesn't have to turn into a fight. There's actually an official guidance note for tax auditors that lays out exactly how to handle the situation. And here's the solution: transparency. The guidance note says your job isn't to force your client to agree with you. Your job is to make sure everything is out in the open. So you state both sides in your report: the client's argument for why it's allowable and your own view based on the law for why it's not. That way, the tax authorities have all the information they need to make the final decision. All right, next up, let's dive into Section 40A. This section gets even more specific with its disallowances. And it's really targeting certain behaviors that the government, well, let's just say they're not big fans of. The most obvious one, big cash payments. You can definitely see a theme here, can't you? First, there's Section 40A(3), which completely disallows any single payment over 10,000 rupees if it's made in cash. The government is really pushing everyone towards checks or electronic payments. Then you have rules about gratuity and other employee welfare funds. Basically, if you're setting money aside for these things, it has to be in a proper approved fund, otherwise it's getting disallowed. Okay, now for a really tricky part of the puzzle. Reporting contingent liabilities. This falls under Clause 21G, and we're talking about potential costs. Stuff that might happen but hasn't yet. So what is a contingent liability? Think of something like a pending lawsuit. You might have to pay out, but you might not. It's uncertain. Now, basic accounting rules say you absolutely should not be debiting this to your P&L account because it's not a real expense. So here's the kicker for the auditor. Clause 21G is only relevant if a company has done the wrong thing and actually booked this potential liability as a current expense. So your job as the auditor becomes a bit of a detective mission. You have to actively hunt for these improper entries. That means you're digging through the details of outstanding liabilities, you're combing through provision accounts, and you're carefully reading all the notes in the financial statements to make sure a maybe liability hasn't been treated as a definite expense. So after going through all these complex rules and gray areas, what's the auditor's final verdict? How do you pull it all together? Well, it really boils down to a few core responsibilities. It's really a multi-step process. You start by getting formal statements or representations from your client. Then comes the deep dive, scrutinizing all the source documents. After that, you have to apply your knowledge of tax law and past legal cases. And finally, as we talked about, you have to be ready to clearly disclose any areas where you and the client just don't see eye to eye. And this quote really sums it all up beautifully. It says, the auditor's role is pivotal in maintaining transparency, accountability, and trust. And that's so true. Going through Clause 21 isn't just some technical bean-counting job. It's fundamental to the integrity of the whole financial reporting process. So that leaves us with a final question, really for any auditor listening. Is your audit report just another form you have to fill out, or is it something more? Is it a foundation of trust? Because ultimately, getting Clause 21 right isn't just about following the rules. It's about showing a commitment to the trust that our entire financial system is built on. Thanks for joining me on this explainer.